To give it a few minutes, Josh. Let others join. I find typically people set their calendar reminders for the exact time, and sometimes it takes a couple minutes. So maybe we'll begin. What do you say, Ryan? At 3 after?
Yeah, that sounds good to me. I see that Josh just joined as well too.
Perfect. Hey,
Got a
Ryan.
got a few more people coming in, it looks like.
Perfect.
How's things going in Ontario, Josh?
Things are good. Things are ever changing. A lot of people finding ways to make money in this market still. A lot of people finding ways to maybe stabilize their current position and portfolio, but real estate never sleeps. Everything's always in flux, everything's always moving. So, being able to have something like this to show people or to outline what services and options are in the market right now is really important. Probably reflects 90% of the phone calls I've had in the last 6 months.
Very
good
good
to see you.
stuff. Perfect. So give it another minute here.
Perfect.
Awesome. So it looks like it's 4:03. I'm sure other people will be joining as well too. What's great about this dialogue is that even if they do join late, they still get valuable content. So my name's Ryan Day with Calvert Home Mortgage. We have a great panel discussion here today. So Josh Findlay from the Findlay Mortgage team, and then Dale and Jesse from Calvert Home Mortgage. And the topic today that we'd like to focus on is how to be successful in a down market. And also on that note, like what to do if you have a failing flip or burr. So the first kind of 40-ish minutes will be a panel discussion. We have a few questions for each of the panelists, and then the end 15 to 20-ish minutes we'll be opening up to questions for Q&A. So great opportunity to have your questions asked. Just a few housekeeping reminders. If you are able to keep yourself on mute, feel free to blast the questions in the chat box there, and we'll answer them near the end of the discussion. But without further ado, I guess we'll do a quick roundtable of the panelists, let them have a brief overview of who they are, and give an overview kind of their career. So without further ado, I guess we could kick it off with Josh here.
Perfect. I always appreciate the kind words. Guys, if you guys don't know who I am, I'm one of the owners of the Findlay Mortgage team. We're a boutique brokerage that specifically helps investors scale their investment portfolio. We work hand in hand with Calvert, specifically to help with clients in Ontario find great financing for their flip projects. Obviously, the market has seen its ups and its downs in the last little while, and we kind of pride ourselves on being able to find solutions that wouldn't necessarily be available with conventional lending. There's been a ton of success over the last few years, and we're finding that people who are really good at following a specific strategy and plan and working with their brokers are able to navigate waters like this. So we decided we want to come on and create some content and to have an open discussion about what you're maybe going to do when market isn't in your favor. So we're having a lot of discussions with our clients right now about the market conditions and what's happening. Maybe if you're in a flip, what options are available out there. We understand that as a consumer who goes into a bank, it can be very challenging to get the best advice because that bank is only able to give you their advice. And there may be a handful of other options. So, I have the pleasure tonight of discussing what options are available and how we can go about helping you.
Perfect. Appreciate the time, taking time out of your busy day, Josh, and having you on the panel here. Mr. Dale Keller, how about yourself?
Thanks so much, Ryan. Yeah, my name's Dale Keller. I've been with Calvert Home Mortgage for over 20 years. I started my career as an underwriter at Calvert, but had the benefit of tutelage of my father, who started Calvert Home Mortgage in 1975. So I was just thinking as prep work for this webinar, how many downturns that Calvert has lived through over our 46-year period. And I would say for myself, definitely 3. and added with our founder probably an additional 3 or 2 major downturns. And we've really found that in our long history, flippers have made money in every market. Certainly no one likes to suffer a downturn in the market, but there's ways to make money in it, or at least to secure your profit better. So really excited to share some of the things that we've noticed that our borrowers have done to really benefit their real estate investment even through downturn periods. So just really excited to be here. Thanks so much as well to Josh for joining us on this with the mortgage broker advice. We really pride ourselves on being trusted advisor at Calvert. So no matter what happens, if we don't cover what you're interested in learning about today, don't hesitate to reach out to us after. So I'll turn the floor over to Jesse as well, my colleague, to introduce himself.
Awesome. Thanks, Dale. Thanks, Josh. Thanks, Ryan, for facilitating this. Jesse Bobrowski, Calvert Home Mortgage. As Dale had mentioned, we do our best, and our goal is to provide an effortless experience for the personal and financial success of others. Part of what we do within that mission, or a lot of what we do within that mission, is to educate. We are fortunate that we've been able to do this for over 40 years. Dale, a few years longer than me. I've been doing it for 15, with Calvert for 7. And we have lived through a few downturns, which is unique for a lot of you in Ontario, because really there hasn't been a downturn to speak of for some time. So Calvert, being based in Calgary, lending throughout Alberta for many years, essentially every 6 or 7 years, we see some peaks and valleys and get to learn from that. And that's really one of the things that makes us successful, is taking that knowledge that we get through various cycles and being able to pass that along to our borrowers, to our brokers, to our shareholders. So that education piece is really big and really important to us, and we're really happy that that some of you have taken the time out of your days to join us today. We will also be giving a copy of this, so don't see the necessity to focus on making a bunch of notes. We'll be able to provide this to you in a copy format.
Perfect. Thanks for the intro, everyone. Got obviously great panelists for this discussion call. And without further ado, I think we get right into it. So while we have Jesse on the line right here, so given the topic, what are some tips you would give to someone who's looking to flip a home in a downward market?
Yeah, so some tips that we always give is going back to the education that Calvert does. Hopefully you've done a lot of planning in advance of your flip. Hopefully you've built a robust plan that you're executing on. And when the market turns, it's more important to execute that plan. Focus on getting the project done. Focus on getting to market. Focus on the things you can control. So you've taken the time to become educated. You're working with great service providers like Calvert, like Findlay. You've built your plan. Ensure that you execute on that. In a downward market, that is emphasized even more, because in all likelihood, what the price you can sell it at today will be a little bit less tomorrow and further down the line. So by sticking to what you've already established and executing on it, then you will likely be able to provide yourself more options. It's when we don't execute and we have a partly finished property, partly finished projects where you've really limited your ability to seek options. You've also very much likely increased your costs. You're going to be borrowing from your lender a little bit longer. You're going to be sitting on the property a little bit longer. So absolutely, it is continuing to execute on that plan, and maybe even focusing even more on execution of the plan. Like if you had built a reno plan where you were going to take 3 months and somehow you can shrink that down to 2 months, that would be a really good idea. So you may have to clear other things off of your agenda or your table in order to really focus on that execution component. Definitely you're not in it alone, and we don't want you to sit and suffer in silence. We want you to reach out, think through the questions that you may have, understand again what you can control and what you can't. I know Josh and his team and many other brokers who we're fortunate enough to work with would be happy to have that discussion with you. Calvert, as your lender, is really happy to have that discussion with you. We have tools like this that will help you think through really what are those questions. A lot of times when things are not, when there is market turmoil, you can sometimes make up stories in your head. And usually that's not helpful. It's usually helpful to think about, okay, what is happening here? What can I control? What do I need to do? And what can I focus on? So we welcome those conversations. We have a really great team of underwriters and underwriter success associates that have probably helped you with your plan, have helped you underwrite your deal, and are there for you. So they're there to bounce ideas off of. They're there to hear what's working and what's not. And no matter how good or bad it may be, we want to hear from you. So that's something that we want to ensure that's clear today is don't hesitate to reach out to your trusted professionals. So that's really the key, is executing on that plan, moving quickly, and reaching out to discuss when you need help. We don't want you sitting there paralyzed with fear. We want to review things and help you build out what those next steps should be. And a lot of times it's just that, taking it one step at a time and moving through the execution of your plan.
Perfect. Great response. Lots of good tidbits of advice in there. And as mentioned before, if anyone has questions, feel free to put it in the chat. We're more than happy to answer them near the end of the discussion. Next question's for Josh. I know you kind of touched on, you've been having quite a few conversations. What advice would you give to a borrower who's currently, they're maybe a little bit overextended, they're on the brink of, maybe financial trouble, looking at, maybe second mortgages? Do you have any advice, tips, suggestions on people who maybe they're a little bit over leveraged, and how they could essentially, hopefully, alleviate some of their financial pain if, maybe they took on too many projects?
Sure. Yeah, this is a common theme. Everybody has a plan A, but not many people have plan B or C. So right now what we're seeing as plan B or C is something that we are looking to execute moving forward. As we all know, interest rates have risen and cash flow is becoming more of an issue for people who are overextended. You need to know that there are options in the market. So what happens is, if you're looking at your project and you feel like maybe you're at like one mortgage payment or two mortgage payments left and you got to figure that out, there are alternative lenders in the space that will allow you to be able to use extended ratios. They will use debt offsetting, so 80%, 100% offsetting on rental properties, increased amortizations, something that will allow you to be able to reduce your overall carrying cost on a loan. Most of the time, the issue or the challenge with what's happening in the market now is people aren't selling the project. Now they're finished, most of them can get to completion, but right now they're all sitting on the market because they're not getting what they want. So plan Bs usually find some sort of product that's going to allow you to use the assets that you have available. If you have a rental portfolio and that rental portfolio is creating, you have like a high rent on all your properties, you can use that to offset any cost to allow you to be able to get into a property and lower your carrying cost for a short period of time on the actual subject property. We're finding that this is usually the solution, specifically because it just allows you for a short-term solution to increase your cash flow on the property, as well as pay out the private debt and possibly even get some of your money back for the construction, depending on if you're in that situation. So another option that we're taking a look at is really understanding your portfolio and how it's operating. Like if you have multiple properties it would be ideal to see which one has the most positive cash flow and understand if we can restructure that debt to be able to maybe get some additional cash to put it towards the property you currently have, so that your entire portfolio is able to kind of spread out the loss in which you're having for a short period of time. That's going to allow you to be able to manage your cash flow position until either somebody buys the property or whatever that looks like. Second mortgages are a hot topic right now. Not always the best option, but sometimes is, specifically if you have really cheap debt and conventional debt on your properties and you're not looking to restructure into like a high interest rate environment right now. Sometimes taking a high interest rate on a small amount of debt makes the most sense if it's for a short period of time. If your exit strategy has all of your capital tied up in selling this property, maybe it makes sense for you to take a small private mortgage in second position for 12 to 24 months until you can execute the sale at the price you're looking to. Now that may have a higher carrying cost, but it's going to allow you to be able to carry both projects and reduce the loss out over multiple, over your entire portfolio, which some people are finding as advantageous. Last but not least is commercial lending, guys. Commercial lending is like the tool that nobody talks about. You can get commercial financing on residential real estate. Now, how I've been advising my clients for the last about 6 months, if you're looking for projects, get projects that have multiple units, specifically because it adds an additional exit strategy that wouldn't necessarily be available. If you have a property that has high debt service coverage ratio, there are lenders out there, usually credit unions, that will allow you to use a debt service coverage ratio to qualify for a mortgage up to 75% loan to value. Now, I know most people who do these flips are in it and they're self-employed. They don't necessarily have the highest T4 income, T5 income. You don't need that to be able to qualify for this. You need good credit, you need some sort of liquidity, and so show some sort of viability in your business. But you can use this exit strategy as a way to be able to verify or confirm your ability to be able to exit. So if you're looking to get into a project right now, I highly recommend a triplex or a fourplex, something that has multiple units, something that has the ability to be able to increase rent. That way you're not going to be in a negative cash flow situation, and you're always going to have an exit strategy moving forward. These are all a handful of things that we've been chatting about with our clients, and most of the clients who were executing in an up market, they're also executing on a down market. They're finding strategies and ways to be able to get in. There are tons of opportunities right now, and as we continue to kind of navigate these waters, it's going to be different products and services out there to support people.
Fantastic. Great answer, Josh. Love the level of detail and depth in that fantastic, robust answer. Lots of great advice and great insights. Obviously, using commercial loans on residential properties, never even, obviously, as someone like myself, never thought to do that. So very creative solutions that you always offer. Dale, question for you. I know as we see inventory, as we see demand start to obviously decrease a little bit, having the right realtor is obviously paramount. Do you have any tips, advice for kind of vetting the right realtor for individuals who are reaching out looking to list properties? I know having the power team and having the right realtor is crucial. So any tips of advice for finding that right realtor?
Yeah, that's a really good question. I really think that surrounding yourself with great trusted advisors for your entire business plan is really important. You've put together people like your lawyer, your lender, your mortgage broker. Love the advice that Josh just gave. Really shows the value of using a broker who understands real estate investors. Likewise, I think that picking the right realtor who understands real estate investors is important. Even more important, though, is just their understanding and expertise of the market. So how I like to vet a realtor that I'm using for my personal home, and by the way, I'm licensed as a realtor, but wouldn't trust myself to be my own realtor. I go to somebody who's got a lot more experience, a lot more depth of experience, who understands the market. Because one of the big things I trust a realtor to tell me about, both upfront I ask them this question, as well as the entire way through the listing journey, is I test their knowledge and understanding of what this property should be getting in terms of showing experience to tell me whether I'm in line with the market on my listing strategy. A really good realtor with lots of listings will be able to tell a properly priced property versus a property that's not well priced and it's not getting the showings accordingly. So I like to test them. Hey, in this market, what are you seeing right now for numbers of showings before you get an offer? How many properties have you listed recently? What kind of market intelligence are you getting all the time on all your listings that tells you how to price a property properly? So those are things that I like to better understand. They don't have to be a high volume producer in order to have some of those answers, but certainly somebody who's got more experience, who's got more listing, who's in the market every day, who's not doing this as a part-time job, but who really understands the ebbs and flows of the market and supply and demand factors is really important. I would also say that the kinds of questions you ask your realtor will help show them what kind of client you are and what your objectives are. For me personally, I'm very much a data guy. I really want a realtor to show their opinion in the data that they see. So when I'm asking for a realtor to do a listing presentation to me, I want to see the backup as to why they think I should be listing at the price they suggest. I'm going to ask questions like, show me the highest price sale in the area in the last 90 days. And I mean the same community as my house is listed. Show me the lowest price property and the last sale of the lowest price in this community in the last 90 days. I want to see the whole range, the good, the bad, and the ugly, and the best of them too, to really get an understanding of the whole market firstly, and then have them help me place where this property is listed specific to the market. Okay, am I an above average property? Am I an above average maybe square footage? How have they arrived at their listing recommended price? And the other thing that I really spend a lot of time with my realtor on is helping them craft their listing strategy to my specific needs. I mean, do I want to list and sell this thing within 5 days? That might be a little bit too aggressive. Maybe that's going to give me up a little bit of price. But on the other hand, do I want to list and sell this price within the next 120 days? Well, that might tell a realtor, yeah, you know what? We can afford to overlist this and just see what the market intelligence back and feedback is in the market. I would say that in a market like today, both in Alberta and Ontario, I wouldn't say that listing with an overpricing strategy is a very wise thing to do, because you don't want to stay on the market too long. And especially with a flip, every month that you don't sell is extra time that you're spending money on in terms of interest. And so, would you rather be priced to sell and sell quickly, or priced higher, sell later, and spend more on interest? And I would argue sometimes that's okay if you're not spending much on interest, if your capital cost and your loan is very low. But if your loan is high and you're spending a lot on it every month in interest, you probably want to sell within a 30 or 60-day period. And remember, you need some time for the buyer to take possession of that property. So you need to budget that into what you're willing to pay in interest. So anyway, those are a few things that I would quiz a realtor about. Again, going back to data, get them to show you the data of why they've priced your property where it is, and make sure you're checking in with them. Does this match my listing strategy for selling in the period of time I need to or want to?
Fantastic. Great answer. Lots of great key insights in there. Next question's for Jesse. So obviously, given your experience, I'm sure you've probably seen a few troubled flips before in the past, maybe flips that didn't work out as planned. From those flips that you've seen, were there any key learnings or, key attributes of each of the flips that made them unsuccessful?
Yeah, it's always the best learnings, unfortunately, are in the projects that don't go as planned. So I would categorize, there's kind of two main themes that we see. And I'll ground the first in a story that we recently heard, actually, while we were in Ontario with one of our volume producing clients. This gentleman and his team flip literally dozens of properties a year. Some they burr, some they sell outright, and he's done extremely well. But he hadn't seen a true downward market. So what had happened was, and this was kind of, as he stated, one of his biggest learnings to date from this most recent downturn. He finished a property in March of this year and was using data from, December, January to establish his list price. And he established his list price and didn't move. And then April comes along, and similar to Dale, he was a data guy, uses the data and comes down a bit. And he did this for, I think he finally sold it in August with a September possession. And the market had moved on him. This property was, I'm going to use easy numbers, about $1 million property. And the property had moved on him about 17% over that time. So what he could have done if he would have if he would have listed a bit more aggressively and not only looked at the comparables, but also looked at what else sold, not only looked at sold comparables, but looked at what was actually listed and been really paying a lot more attention to that, then he could have lost $170,000 less just on market value. Never mind, he was paying us around 10% annualized on that loan. So those things add up. So the learning to him was, I should have been even more data driven. He let his ego get in the way a bit. He had said a story to himself that I don't lose, I always sell at my price. That's great. But when the market changes aggressively, you need to reestablish what your price is. You need to reestablish expectations. And in a lot of times, sometimes your first sale, a lot of times your first sale is your best sale. So your first sale is your best sale for profit. And sometimes when you're in the unfortunate position to lose money, your first sale will limit your losses as best possible. So this gentleman, he broke even on it, but he left a lot of profit at the table. So it's not a win-loss equation. It's sometimes we're going to make money. Sometimes we're going to make a lot of money. And every now and then there's going to be variables that act against us and we may lose. And to realize that loss sometimes quickly, to move on and to redeploy into the next project is often a very sound decision. And it's a decision a lot of our best borrowers, a lot of our most sophisticated borrowers use. Take the loss, take the slim margin, take the big margin, and move on. There's a really good saying, the greedy get needy. So as you hold out hope, you may become more and more needy. So that's one scenario where the person executes and they unfortunately chase the market down. We're building a really good illustration for this just to kind of ground it. But we get it, right? Like for our borrowers in Ontario who have not seen this, sometimes, unfortunately, you have to experience it to believe it and to put it into your business, your decision-making model. Another common theme is where our borrowers don't execute. So they get distracted. Maybe they take on too many projects. Maybe they see the market turning and get less motivated to finish. But these are where the biggest problems occur when we don't execute our plan, when we're sitting on a partially completed property. Calvert, as your lender, is going to have very little options for you. Other lenders, probably the same. Josh is really going to limit his ability to help. And a big thing is one of the biggest fixes, which is selling. You're going to have a really hard time doing that when your property is partially complete. So some things, again, that will contribute to you not completing will be taking on too many projects and not being able to manage properly. Of course, life events happen and we have to attend to other things. Those are really fortunate instances, but also where you lose motivation because of the market, which is, I think, a really bad strategy. Oh, I'm not going to sell as much as I could have, so I'm going to wait this out. Oh, the market will come back, so I'm going to wait this out. By all means, will the market come back? Yes. When? Really hard to tell. It may be months, it may be quarters, it may be years and years and years. You know, some of the biggest corrections we've seen in Alberta, it took, you know, a year or two to hit bottom, and then a year or two to come back to equal to what values used to be, and then a long time. So going off of hope of timing the market is a thing that we see sometimes, and very rarely do we see it working in the in our borrowers, in our clients' best interest. So those are the two things: executing and not understanding the market, so not pricing right, and in turn not selling right, or not executing. You know, I think this is even the not executing part is really critical to BRRRRs, because you don't even have the BRRRR option in front of you if you haven't executed. So those are kind of the two main themes, Ryan.
Perfect. Yeah, no, love the story. I find stories definitely always paint a picture and add a lot more personal touch. Next question's for Josh. So I know we're seeing a lot of lenders, us included, kind of altering policies, changing loan to value, updating the rates, what feels like almost daily. Do you have any tips or advice for real estate investors, either to be more bankable in 2023 or any action steps going into the new year that you recommend real estate investors take now to help with their ability to finance loans in the future?
Yeah, I mean, as you said, you know, it feels like every single day the banks are changing the way in which they're lending, and rightfully so. So banks are for-profit organizations, and as they have risk, increased risk, they're going to increase how difficult it is to be able to obtain a loan, not just through raising their rates, but by maybe tightening some of the policies that they would have from underwriting perspective. So what we're seeing right now is some of the underwriting guidelines that were given out by the A lenders and B lenders that were lightly looked at maybe a year ago, where maybe refinancing within a 12-month period, it was fine because you're in an up market, it's not a problem. Now it's becoming extremely difficult to be able to get those exceptions. So, you know, if you're looking to execute a BRRRR with an A lender, understand that Scotiabank, for example, they do not allow refinances before 12 months. So now that the market is tightening up, your exit strategy with an A lender might not be as viable, even if you can qualify with your ratios, because, you know, they're no longer allowing those refinances anymore. So just understanding that things are going to get more difficult as the overnight lending rate does increase, but there are options available for you. So the first thing that we do is really just assess the sophistication of our client if they had a plan B or plan C. You know, there's many different strategies involved to exit on your loans. So the first is essentially like A lending. You know, the tight up the lending, as I said, the 12 months refinance. If you are getting the exception on your 12-month and in refinancing for the 12 months, they're requesting proof of your initial down payment and renovations when you originally purchased a property less than 12 months ago. Essentially meaning if you source capital from a JV partner, it's not going to fly. If you sourced renovation money from people and you borrowed on prom notes and it shows giant like deposit in your account that you can't account for, it's not going to fly. So like they are becoming more strict in regards to proof of funds as well, and how they're going about looking at the initial purchase. So one of the advantages that you can do is if you are taking on a property that does have a legacy tenant in it, try turning them over. Like part of your strategy, instead of just, you know, renovating one of the units or two of the units or three of the units, try turning it over to get higher rent. That's going to help you at least get your debt servicing ratios in line. I know that we spoke about B-lending a little bit, but offsetting is probably one of the most powerful tools that most investors don't understand. We are going to actually holding like a seminar in the early next year, outlining how to actually understand the financing around it, because I find that one of the weakest parts of a real estate investor is the true understanding of financing and the options available to them. So shameless plug, but talk about it later. B lending. So the rental offset is super powerful. If you have a portfolio, I can essentially take 80 to 100% of the rental income coming in to offset any cost on that portfolio to allow you to be able to get your ratios lower to qualify conventionally. If you qualify with a B lender, your fees are drastically reduced. Your amortization is up to like 40 years with some of these lenders now, which is going to allow you to increase your cash flow position and hold on for a much longer period of time. What we're finding is if you're underwater on a property, most borrowers would rather take a $200 or $300 negative cash flow situation and make sure they have reserves in the bank for 12 to 24 months, take a $5,000 or $6,000 or $7,000 carrying cost loss versus taking a $50,000 or $60,000 or $70,000 hit on their projected ARV that's no longer realistic in this market. So, getting cash flow or getting a nest egg and putting it away and understanding what your negative cash flow looks like is going to be maybe a harder decision, but it's going to allow you to take less of a loss. Now, again, as Jesse said, nobody knows when the market is going to come back. Could come back in 2 or 3 quarters, could come back in 2 or 3 years. So we fully expect the Bank of Canada to continue to raise interest rates. I'm a big numbers guy, a lot like Dave. I think last time we spoke, we were talking about numbers and what that looks like. Bank of Canada has continued to say they're going to continue to raise interest rates, and we expect them to do it probably in January again and possibly hold off. But I take a look at historical numbers, and what goes down must come up. And I think the bond market is going to start pricing in the increase or the decrease in inflation, which will then decrease fixed rates, which might then spur a little bit of movement in the market. So just something to keep in mind is we don't really know exactly what's going to happen, but history does give us like ideas and hints as to what's going to happen. So we do expect at some point things are going to get better, hopefully. Last but not least, commercial financing. This is one that most people don't know about, but as I spoke about previously, this is a great exit strategy for people who are looking to find a viable long-term plan to hold a property. So these rates are comparable to AAA rates. They're roughly around where Scotia is at the moment. The advantage of this is Ontario has just released a handful of different bills that have come out that have allowed for increased density without site plan. It also allows you to have up to 3 units in your property without going through a ton of the red tape. So as long as you're in the process of getting permits and you're realizing that your ARV numbers are no longer where they're going to be, maybe injecting a little more capital in a project is going to allow you to have more units, is going to allow you to generate more income, either hold it for a long period of time or to increase the ARV that wasn't necessarily there, because a lot of people are looking for that secondary dwelling or that 3rd unit in a property to add as a mortgage helper, because in an inclining interest rate environment, the people who are looking to be buying are the first-time home buyers or the millennials, people who maybe necessarily can't afford to own the home by themselves, but if they had a secondary suite or they had a unit in there, that would make it more marketable and that might move faster than what a normal property would have. There's a lot of really cool things happening with increased density in Ontario, and if your initial plan isn't working right now and you have access to other capital, maybe looking at creating that ADU and taking advantage of some of the changes in the market and in policy are going to allow you to be able to continue to execute effectively and maybe change your strategy a little bit.
Fantastic. Love the level of depth in that answer. Question for you, Dale. Last question, then we'll open it up to Q&A here. Given your experience, I'm sure you've seen a lot of borrowers hold properties longer than they need to. For borrowers who have properties on the market right now, say it's been on the market for 1, 2, in some instances 3 months, and houses aren't selling, what advice or even data would you suggest them looking into in order for them to kind of revert their plan and take a look at a plan B?
Yeah, I think I love the way Jesse put this already in terms of control. Like look at the things that you can control. And I would include in that what the realtor can control and what you can control. So 2 different things there. Ask the realtor, what am I doing that could affect my listing? Let's look at the pictures of the listing. Let's look at the remarks in the listing. Let's look at make sure the data in the listing is actually accurate. I've certainly even experienced my own realtor making a mistake on the data of my home that affected the listing. So doesn't hurt to have another look at that. But ask the realtor, what do you see in my listing? Is there anything I can do to improve your ability to sell my home? This does 2 things. Number 1, you're going to get some feedback. and you're going to want to act on some of that feedback, but you're also telling the realtor, hey, I'm willing to dig in. Will you dig in too? Because my next question is, what can you do that can help me sell this home a little bit better? And maybe they've got some ideas that they haven't executed, but the power of asking that question to the realtor might unearth some other thinking. You know, they might try and put it all on you. I think, well, maybe you should stage it better. But okay, well, what can we do if I staged it better? You know, how would that result in your listing suggestion? So, you know, having that open conversation back and forth, what are the both of us in control of, and what can we do? The other thing that I would mention about that control that I really love that Jesse mentioned is really opening up the conversation around fear and not taking action. Like in my history of working with borrowers, I know it can be really tough if you're looking at a property that either isn't earning the profit that you thought it would, or maybe you're even looking at a loss. It can be very difficult, and sometimes that fear or disappointment gets you working less on the project instead of more. So I think really looking at that control aspect and saying, what am I in control of, is really empowering, and it might be enough of the juice that gets you through to take action on that. The other thing I would do, if you're interested in learning a little bit more about how to value properties, so that you can check in on, does my realtor have the skill and ability to value the property the way I want them? Are they looking at the detail? You could check out, Calvert has a YouTube video on how to value a property, about a 45-minute, hour-long presentation on how to look at the value of a property. You can get the details of the data from the realtor, but do a second check on them if you're interested in digging in a little bit deeper on how to arrive at the right conclusion of value. I think that's always a good idea, especially if you've been on the market for a protracted period of time. You know, I don't think you need to go through that exercise every week. You probably drive yourself nuts if you go through every week, but maybe it's worthwhile going in every 30 or 45 days to do a check-in on that. And actually, that's an excellent question to ask your realtor. How often do you review the value of my property? And so that we can stay on top of the list price. Jesse kind of alluded to it earlier with his one story about listing a little bit, changing the list price a little bit behind where the market was moving, and looking at the competitive listings of what's active out there can help you determine who you're competing with, who's going to sell next. And so we talk a lot about people following the market down by, you know, not getting ahead of where the price is, but staying way behind where the price is. And so if you follow the market down and you're reducing your list price, but not enough to be a competitive listing, then you're kind of what we think of as following the market down, and you're not attracting that buyer quick enough compared to the rest of the listings in the market. And then another comment, it's a little bit off your question, Ryan, but I think it's important to mention. One thing that we often see, especially around this time of the year, is a lot of realtors and real estate investors start to think about, maybe the spring is a better time. Maybe I'll wait and see what the spring will give me. And there's a lot of great conventional wisdom about the spring bringing more opportunities, but I would draw a really big distinction between the spring being higher volume of sales, which is normally true, but that doesn't necessarily translate into higher sales prices. You can have a downward trending market, and supply might pick up and demand might also pick up in the spring. But if demand still is less than supply, you can still have a downward market in a spring market. So my suggestion for real estate investors in any market is, what dictates your time of sale is when you're done your renovations. And I would even say, get that realtor in the property, a week or two before you're finished your renovations, to start getting them thinking and working on that listing, so that you can be on the market as soon as you're 100%. Because waiting on the market is likely not your friend. It might have been in higher markets like we experienced in Ontario a couple of years ago, and even a full year ago. You wait around in the market, and your house price actually increases. But unfortunately, we got to reverse that logic into this current time, and because it's usually the opposite. The other thing that I think I just wanted to make as a general comment about our history of lending in the market with flippers has really taught me and it gives me a lot of excitement, is that generally speaking, the very worst time to be a flipper in any market is when it's starting to change into the downward cycle, because you've likely bought the house not appreciating or understanding that the market's about to go down. And so that's the hardest point to own a flip. But our experience in all of the downturns that we've been involved in supporting flippers is once they're kind of wise and appreciative and understanding that market's going down, now you can start making good money flipping. And the reason why that is because you can kind of price in the softness of that market into your current business plan. So you make your money on the buy is what we always tell flippers, and flippers say in the market all the time. And what that means is you've locked in your pricing on the purchase. And if you bought right, you're going to make money. It's a lot harder when the market changes in that. But even in a down market, you can start to understand where your pricing threshold ought to be in order to maybe price in some softness over the next few months, but still buy like you're going to make money, even despite that softness. So that's why, frankly, we look at stress testing the flips that our clients are doing. Are you making enough profit that you can withstand a little bit of softness if you sell in 6 or 8 months and the market's a little bit soft by then? So making money on the buy, doing the right due diligence up front really helps. And I want to give confidence to people. I think Jesse put it best, or, taking your sale quick to recapitalize that money into the market, you can have a better opportunity to make money. So do that as quick as possible.
Fantastic. Love the level of detail. And yeah, great comments for sure. Obviously, given your experience. So that was it for the questions that we initially had. I see a few questions in the chat that we'll get started on. So it looks like the first one's from Lordine. And the question was, what would be the best types of mortgages as the interest rates go up, closed, variable, etc.? Maybe Josh might be the best representative for that question.
Sure, that's a tough question depending on what camp you're in. I mean, I would say that I'm in the camp of, I believe that interest rate, we're at pretty much the peak of where I believe interest rates are going to rise to. That's all, I think it's all perspective. If I were be purchasing with conventional financing right now, I would most likely be in a variable term, specifically because of why lock in at the top. I think that fixed rates aren't going to go much higher. I'm thinking fixed rates aren't going to go much higher. So if you're going to catch a rate right now, I'd say variable probably only has another 25 to 50 basis point increase left, and you might be okay catching it on the way down. Most people, I'll answer the second question behind it because it's essentially the same thing. Most of my clients right now are looking at taking a 2-year term, specifically because if you take a look at the data and how this usually goes, we're expecting the Bank of Canada to obviously stop inflation. As inflation starts to decrease, the bond market starts to price in that decrease, which will then decrease fixed rates. Most people are planning on catching a lower fixed rate if they have to buy right now within the next 2 years. And they're believing that 1 year probably is a little too short, but 2 years basically guarantees a lower rate than what we would normally see right now in the market. Again, no one really knows. We're all just kind of guessing as to what it looks like and looking at historical data and what has happened in previous recessions. But most people are taking right now a variable term, and they're probably projecting on breaking it into a lower fixed term in about 2 years. And that's the same with commercial financing as well. Most people are taking a shorter term to try to catch a lower fixed on the way down.
Perfect. Yeah. Thanks for the context there, Josh. Really appreciate that. It sounds like, yeah, you answered Fanny's question as well too. If anyone else has any other questions, feel free if you want to unmute yourself or put it in the chat. Now would definitely be the time.
I'll jump in while we're waiting for some questions, because I know, Josh and I have had some discussions lately on on what's happening in the market. And Dale had mentioned in our history, you know, we see people successful in any market, and definitely where we see the highest likelihood of people not being successful is when the market turns fast and by a large drop, which we've seen over the last 6 months, call it 9 months, right? Since March here. But we are seeing opportunities. Some of our most successful flippers are getting back in the market. Some of our most capitalized flippers are getting back in the market. Definitely what we had heard prior to, so let's call it February of 22, for almost a year and a half, was from a lot of flippers. The common issue was nobody was able to find good flips. They couldn't buy right because the seller psychology was just there, where people weren't willing to sell at at sometimes the right number, or those private market borrowers, all they saw was the press clippings of the market is super strong, and they held a lot of negotiating power. Whereas as we're seeing the market turn to what is a more balanced market, really, like a lot of the markets in Ontario, we're still only seeing 3-4 months supply. We're not seeing supply run out of control, but this is abnormal for Ontario. So it's normal for most markets, just abnormal for the extra heated Ontario market. So I guess what my point is here is we are seeing opportunities in this market. We are supporting opportunities in this market from Calvert's perspective. And I know Josh is seeing us and a number of other lenders looking to support smart decisions.
I've got a question for Josh. Josh, you mentioned earlier that you're helping people explore a plan B or even C. And we've often thought about this with our borrowers as well. Like, you know, maybe a flipper's plan A is to sell the property, but should they be checking in with their mortgage broker about a plan B of refinancing, which I highly recommend is a good idea to explore. My question for you would be, oftentimes I see people taking a listing off the market in order to apply for financing. And what would your best advice be in terms of when to do that? Only when you, the mortgage broker, suggests, okay, I'm closer to an approval, now take it off the market? Or what conventional advice would you give people?
Great question, because I've had to deal with this quite a lot. I feel as though plan B usually involves, you know, telling the story. Things didn't go as planned. Our job is to find a conventional solution to allow that person to manage the situation. So most of the time when a commitment is issued, the commitment is issued and it outlines one of the conditions is to have the property not listed. So you don't necessarily need to list it before you tell us. I'm going to tell the lender anyways what the situation is. You were in a property too long, you had too much market exposure. It's not selling for what you had into it. Here's your renovation budget. Here's your current situation. Here's why it's going to work. And here's the solution to get out of it. It's currently listed and we're not, it's not selling for what we'd like it to. We're going to hold it for a prolonged period of time, looking for a 12 to 24 month term. It doesn't necessarily hurt to keep it on, especially if you do get it until you close. Like, I need it done before you close. I need it off market before we close. So probably like a week before we actually close, and the lawyer gets your documents. You can probably have it up for that long, but the lender is going to want proof that it's taken down. At the end of the day, most of these solutions are alternative solutions. With usually a B lender, most flippers who are doing this professionally don't have a verifiable T4 income. They usually have some sort of corporation where we're using a business for self bank statement mortgage, something that we can be a little more flexible with to help you get into a product. So it's all about the story. Be as upfront as possible with your mortgage broker, because that person's going to, they're on your side. They're here to create a solution for you, but you do have to have it off the market before you close on the property.
Great advice.
Yeah.
Good stuff. I guess we'll do a last round for questions. If nothing comes up, we'll give you 5 minutes back into your evening there. As Jesse mentioned, this will be sent out a day or two after this recording. We'll also put a link into our free flip analyzer video and a link on the video that Dale was referring to on how to value a property. So that will be distributed in the next day or so for everyone on this call and whoever wasn't able to make it. All righty, I'll take silence as golden then. If any questions do come up, feel free to reach out. And with that, thank you very much for taking time out of your busy days to join this video call. Hope you got value out of it. If you have any feedback, we're definitely open to feedback. If you'd like to see a future, webinar on a specific topic, we're open to all suggestions. So thank you very much. Thank you very much for the panelists, and have a fantastic evening, everyone.